Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And we're back from our 1 week hiatus. I heard there was an election.
Yeah, it feels like the world changed completely, doesn't it?
There was also a Fed meeting. I don't know if that changed too much. But in any case, let's get to the biggest stories right now in the more than $14 trillion global ETF industry. And as President-elect Donald Trump claims victory, traders snapping up risk asset ETFs from Bitcoin to small caps to bank, all seeing a surge in inflows tied to that Trump trade.
So the election outcome has made BlackRock go all in on momentum names, putting about $2 billion into its marquee fund as part of a model portfolio shift.
And sticking with the political theme as the GOP nears a House win, a red sweep, Value investor Rob Arnott discusses the election effect on the market. Before we get there, though, as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, you said it all, right? This is the Trump trade gone crazy. I mean, this is like, I've been covering ETFs for, I don't know, almost 20 years. I've never seen a 3 days this intense with the flows. I'll show you what I mean. So SPY, 12.6 billion. I mean, that would be a lot if all ETFs took in that much. That's just one ticker. The Qs, another 5.7 billion. And these are the trading crowd. You look down here, VU taking in more than it does, but it always takes in flows. But 4 is even big for it. So it's sort of like a party where you've got the traders and the retail crowd both climbing in as fast as possible. And all of these are risk on. I would put Bitcoin down there, I bet. Also risk on. 1.25 billion is a lot for Bitcoin. And then Katie mentioned the momentum trade that BlackRock is in. So this is a lot of Mag 7, a small caps extent. It was quite a small exception here. But this also, I think, is linked to animal spirits in the market right now. Let's look at the outflows. And you can see here that it's a lot of safe havens. So gold, this is the biggest outflow in a week since 2022, right? Remember, that was that bad year. And then bonds, utilities, right? So a lot of money moving out of safe havens into total risk on. That's where we're at right now. So let's do a little comparison of those 3 days since the election. And we went up and looked at other 3 days after the election periods, because I thought this felt really intense. In 2016, when Trump won, I think even though stocks rallied, ETF investors were a little caught off guard by that win, and it took them a while to get the flows going. This time, they're like, oh, yes, he won. Let's go into the market. This is the flows since Trump won, 3 days. This is when Biden won. So it was pretty good after Biden, but nowhere near that. And this is Trump 2016, right? So you can see here how absolutely abnormal this election has been in terms of ETF flows coming in at this intensity, Katie.
Yeah, it has just been wild to watch. Eric, thank you for that roundup. And let's keep the conversation going now with Rob Arnott. He is the chairman of Research Affiliates, joining us at the desk. It's great to see you in person again, Rob.
Wonderful to be here.
So the last time you were here, we spoke about the launch of the Research Affiliates Deletions ETF. This is a really fun one, of course, picking up stocks that have recently been booted out of some of the major indexes. You take a look at its post-election day performance, up 4% last Wednesday. It felt like everything went up that day, but the S&P 500, for context, was only up about 2.5%. So a big outperformance there. How do you explain it?
Well, it's a couple of things. Firstly, the companies that are in the NIXT index. We launched the index last June, at the end of June. It's up 18% since then. Part of that is small cap doing well. Part of that is value doing well. Part of that is the rebound effect. When companies get kicked out of indexes, they tend to outperform for 3 to 5 years after they're kicked out because they've been pushed down so hard by the bad news that led to the deletion and the deletion itself. Since ETF Architects launched the ETF, it's up 13%. And post-election, as you've noted, it's, I believe, up 6-7% since the election. So it has done what it is intended to do, to participate when value is coming back from being out of favor, when small cap is coming back from being out of favor, when the deep value, out of favor, unloved stocks that get kicked out of indexes come back. I like to joke that some of them go on to achieve great failure, but some of them actually come back very nicely. If you have two stocks, one doubles and the other falls in half, that two-stock portfolio is up 25%. And that dovetails nicely with the historic record that deletions tend to beat the indexes that they came out of by 28% over the 5 years after they're kicked out.
Part of this, of course, also is the election effect as well. You've noted that history shows the stock market often rebounds before voters head to the polls, before Election Day, because there's going to be a removal of uncertainty. And of course, your data also shows that markets tend to rally after the Election Day outcome, too. Usually, when you have a big event risk, the dynamic is buy on rumors, sell on news, on something anticipated. Yet in tightly contested elections, it's buy on rumor, also buy on news. How do you explain that?
Actually, it's very straightforward. This is a bet that I've made personally many times in the last 30 years, and not just in the U.S., in Taiwan and a host of other countries. When there's a contested election, what you find is that both sides are terrified that the other side's going to win. Once the election happens, so both sides, some are terrified enough to go risk off, to take money out of the market. And when the election happens, one side breathes a sigh of relief and says, okay, I'm going back into the market. And it doesn't happen overnight. So some of it happens immediately. Some of it happens after a while. Some of it happens in the days approaching the election. So as the election approached, it looked like Trump might very well eke out a win, and the odds were starting to shift in his favor. Markets were starting to move a little bit. They exploded to the upside when he won. And it was not because of him winning, it was because his side and the other side were both risk off, and his side was happy to go risk on again. So we see this again and again. If it's a split election where Republicans win the presidency and Dems retain one of the houses, or vice versa, the outcome's the same. There's generally about a 4% rise from a week before the election to 5 or 6 weeks after. If it is, and it doesn't matter who wins, if it's a trifecta, on average, it's about an 8% rise. If it's a Republican trifecta. If it's a Democratic trifecta, it's still a 2% rise. So the market rises regardless who wins. And the reason for that is that both sides are scared and risk off leading into the election.
So I'm looking at all the performance since the election, and everything's up a lot, including the Qs, SPY, small caps, value. I mean, you can't go wrong. If you didn't make money, you have a problem.
You had to try.
Yeah, but let's talk about value in small caps. I've seen this movie before. They have this nice little month or week, and then it's just they get rolled over by the Qs. Do you think Trump as president and his policies can make a regime change where small caps and value can actually lead the way?
I think they can lead the way, and not because of Trump winning, but because they are so deeply depressed already. I love asymmetries in risk. The macroeconomy, the narrative is everything's fine, no reason that it won't stay fine. Well, a solid growing economy can surprise to the upside and become a booming economy, or to the downside and have a slowdown, which is more likely. I think slowdown objectively is more likely than accelerating from already robust growth. Inflation, break-even inflation, expectations over the next 10 years baked into the bond market pricing, 2.3%. That should mean that 3.3 or 1.3 are equally likely. You ask 100 people, which is more likely, 3.3 or 1.3, 95 of them will say 3.3. So there's an asymmetry in that risk. Each of these works to the benefit of value and to the benefit of small cap. And small cap and value are trading cheap, historically cheap, relative to growth and large cap. So you have a relative valuation bias to the upside. You have an economic bias to the downside, which is good for small value. And you have an inflation risk bias to the upside, which is good for small value. So I look on small value as the one place in the U.S. stock market that's cheap enough to be a bargain.
Well, Rob, somehow we only have a minute left with you, but I want to talk about that risk of higher rates, because I take a look at NIXT, for example, NIXT. Your average weighted market cap is about $6 billion, so pretty small there. And, you know, you have some people saying that with Trump's policies, they could prove to be inflationary. You know, maybe the Fed is on hold here, or maybe they could even hike rates. And a lot of these companies have been struggling under higher rates when you think about their debt loads. How big of a risk is that to NIXT?
It's a risk to NIXT, but relative to the market, it's a benefit to NIXT. Here's how that plays out. If you have renewed inflation, the discount rate goes up. That discount rate means that the spread in valuation between growth and value narrows, so that value wins relative to growth. You also have increased uncertainty, and increased uncertainty means people want to move risk off. If people want to move risk off, they're going to take money out of their most volatile parts of the market. That's the frothy growth. So what we find is upside inflation surprise is good for value. Not necessarily small cap value, but good for value. This is small cap and value. I think on a 10-year look-ahead basis, our outlook for the next 10 years for the S&P is 3% a year. Our outlook for small cap value is north of 10% a year.
All right, Rob, great place to leave it. Great to see you in person again, of course, talking about NIXT, which is up almost 11% since its mid-September launch. That is Rob Arnott of Research Affiliates. Now, coming up, BlackRock leans into stocks after the election as the world's biggest asset manager puts big money into momentum. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start, of course, with JEPI. We haven't talked about JEPI in a while. Of course, this is the JP Morgan Equity Premium Income ETF. It's nearing in on $40 billion in assets. This, of course, has been a blockbuster for JP Morgan's active ETF ambitions. But JP Morgan would like investors, of course, to shift away from the JEPIs of the world, where you kind of know what you're going to get, into maybe the more traditional stock-picking ETFs that are out there. We'll continue to watch this one. But let's also talk about KRE. We know that the financials in particular got a lot of love after Donald Trump won the election last week. You can see that KRE in particular, this is the regional bank ETF, took in its biggest one-day inflow on record after the election. So there you have it. And keeping with the theme here, let's also talk about MTUM. This is the iShares Momentum Factor ETF. BlackRock's model makers were at work last week, and you can see that this ETF actually took in close to $2 billion in a single day after the election. BlackRock betting here that that risk-on post-election rally, Scarlett, will continue.
All right, let's talk more about momentum and MTUM and BlackRock with Bloomberg's Emily Garfeo, who's been writing about this. So I guess a lot of this is that there is no more of an uncertainty discount. That's evaporated now that we have an election outcome. But what really caught my interest was this idea that they don't need to or want to fuss around with tactical sector bets. They're just saying, go all in.
Just go all in and buy. I thought that Michael Gates, the lead portfolio manager for BlackRock's target allocation ETF model, said this very poetically. He said, the uncertainty discount embedded in market prices should begin to thaw as the election uncertainty is kind of priced out of the market now. He said that companies that were, maybe not deploying capital are now going to be, now that we know who the president is going to be. So they're adding more to equities. And Katie had written about how just in September, BlackRock's models had dialed back the equity exposure, and they bought more bonds. They bought IUSB, which is a core bond portfolio, and they actually sold IUSB for this current bout of model tweaking.
Yeah, it's really interesting. And of course, the large reason why we care about models and the movements that they're making is because it's interesting, but you also think about the size of these model portfolios. Just small tweaks, small adjustments can cause big flows, as we're seeing in this week's data.
Yeah, we saw this was a record flow into the Momentum ETF, which you guys had just shown on the chart, $1.9 billion, and then $1 billion out of that core bond fund. The Momentum fund was interesting. The top holdings, NVIDIA, which you would expect, but then JP Morgan was the second largest holding.
Well,
I guess
the banks,
that's a momentum stock.
Yeah, the banks have been hitting all-time highs in this wacky post-election world.
Consolidation, M&A, all of that is coming for us.
Yeah.
I also want to ask you about BlackRock and its plans to launch 2 money market ETFs. This was something that Texas Capital Group had started, but it looks like BlackRock sees a trend here.
They're getting in on this. And I was actually looking at how many assets the Texas Capital Fund has already amassed. It's at about 46 million.
It's not bad.
Which is not bad for just 2 months of trading. And it's from, a smaller ETF issuer. So maybe BlackRock is noticing a trend here and trying to get ahead because they obviously take in a lot of flows.
Yeah, interesting timing though, because even though you are seeing that love for that new ETF from Texas Capital, I hear the Fed has cut rates 75 basis points already, so maybe they top-ticked it.
But we're still seeing all-time highs in money market funds.
That's the thing,
Fresh
right?
record highs just on Friday.
All that money that's supposed to be unlocked and get to work, none of it has really left.
Yeah.
People are scared, I guess. They just want that stable.
They like the stable
money
income.
market-esque type fund, I guess.
There you go.
All right, well, thank you so much, Emily Grafeo, who, of course, covers ETFs for us here at Bloomberg News. Still ahead on ETF IQ, we're going to drill down into the Managed Future Strategy ETF as it turns 5 years old with Dynamic Beta's Andrew Beer next. And just a reminder that you can listen to Eric and Joel Weber on Trillions, their podcast that covers the industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we are looking at DBMF, which is the IMDBI Managed Future Strategy ETF. You may remember this thing from 2022. That's when it had its big breakout moment because it was up a ton when everything was down. And that's sort of what managed futures are supposed to do. They're trend following strategy, but they're hedged as well. So if you look at the correlation of this, it's basically zero to both the stock and bond market, mostly everything. So it's a great diversifier. That's what people use it for, because when it rains, this thing goes up. So you got 85 basis points as the fee. It came out about 5 years ago. It's got $1 billion. I find this interesting. When it had its big heyday in 2022, it held on to a lot of the assets. So that's a good sign for the next time the markets get stormy. It's got a nice base. Let's look at the holdings here, and you're going to see it's just derivatives in order to copy the 20 CTA hedge funds that it's mimicking. Let's look at the performance, which is more interesting. We're looking at, there's no managed futures ETFs to compare it to that were 5 years old, so I got SPY and AG here on the performance. And what you can see, if the chart comes up, is that the returns, it's 38%, less than stocks, way more than bonds. But right here, 2022, see the white line? That's DBMF. This is stocks, that's bonds. That's why it was such a big hit, and that's why people use it, Katie.
All right, Eric, thank you. And joining us to talk about this ETF, I'm pleased to say we have Andrew Beer. He is founder and a managing member of Dynamic Beta Investments, joining us on set. Great to see you again.
Thank you for having me back.
So let's talk a little bit about DBMF and just talk to us about the roller coaster that this year has been. Of course, it seems like you're doing pretty well right now, but October was a really brutal month, and this fund provides such an interesting look into what some of these professional traders are holding and investing in.
Yeah, so we've been calling this the year of the whipsaw, and there have been some head-snapping whipsaws this year in the markets. And actually, the really frustrating thing, when you're an investor, you can get the idea right, you get the timing right. And so what we, as Eric mentioned, what we seek to do is we seek to identify what these 20 large managed futures hedge funds are doing. What are the trades they're seeing? What do they find exciting? And in July, they nailed the Trump trade. They had it. They were long equities, they were short bonds, they were long the dollar. And then you had this massive 2-month market head fake where they essentially got out of a lot of those positions. So managed futures funds tend to do very, very well when you have these strong regime shifts, these changes in the markets. And the reason they tend to do well when others don't is because most investors aren't equipped to handle those changes. They like to be the steady hand at the wheel and not change what they do. But this is a nimble hedge fund strategy that's been around for 50 years, and it's worked in all these different market conditions. The question is, how do you get access to it?
Yeah.
And that's what we were trying to solve here.
So this ETF is actively managed. How much turnover is there in the top 20 CTF hedge funds? I mean, how often do the top 20 drop out and a new group take over?
So we track an index that is published by SocGen, and every January they say these are the 20 guys. So they change it once. They change it once a year. Now within those 20, they're changing what they do all the time. You know, if the yen stops going down, then they'll get out of their short yen position. If crude oil starts going up significantly, they'll be in crude oil. So what we're trying to do is capture the dynamism of what they're doing, but in a very predictable index-like way. And so our approach is not to try to beat them at their own game, but as Mike Regan said when I was on his podcast, we try to beat hedge funds at their own game by figuring out what they're doing, but doing it more efficiently.
Let's talk about the hedge, because when I think of this, I think this is something that's insurance. You went up 21% in 2022. Stocks and bonds down both like 13 and 17%. Is that always guaranteed? Like if the market just has a bad year like 2022, will this always go up, or like how much hedge is there?
Sure. So one of the things that is devilishly frustrating about the strategy is that it will change what it does. So it likes to follow momentum in the market. So right now we're long equities. Why? Well, equities have been going up. And so, you know, unlike a macro hedge fund manager who's telling you, you know, this is where rates are going to peak, this is what's going to happen in 6 months, we're going to hit the mother of all bond market tantrums in a year, whatever it is that they're saying, that's not what this strategy does. This strategy is extrapolating information from the markets to try to figure out what the next move is going to be. And if the next move is up, it's going to be looking for up.
Right.
The reason it does well in these big movements, in a year like 2022, the GFC or the dot-com crisis, is because when everything is going south, they love it. So we used to say that basically when you're in this sea of red, it can be a beacon of green.
All right, we only have 30 seconds left, but in those 30 seconds, I'm really curious to get your opinion on basically these private market ETFs that some issuers are shooting for. I imagine you have an opinion on them.
Well, sure. So look, the great greenfield opportunity, right, is how do you build the alts solution for the model revolution? Right? No one's figured it out yet. I think we are years and years ahead of some of these other firms doing it. In general, a lot of the firms that are doing this were also the same ones that said, we can give you a great hedge fund mutual fund, a great hedge fund ETF. In general, those have been a catastrophe for investors, but perfectly good for them. So I would say, if they do it right, it will be wonderful for investors. It will give them another tool to work with, but caveat emptor, and do your homework.
All right, perfect timing, Andrew. I hope to have you back soon. Great conversation, as always. That is Andrew Beer of DBI. And you can read about this drill down, plus the latest news in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/newsletters. But that does it for now for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett and Eric, and this is Bloomberg.